Hi there, my name is Mark Sebastian. This is Trading Direction, the option pit method, using volatility to improve directional trading. This is me. No, not the good-looking redhead, the less good-looking brunette dude in his 30s. I was a floor trader for about a decade. After I left the floor, I started Option Pit. Option Pit is a consulting and education firm. On the consulting side, we work with money managers, hedge funds, asset managers, professional traders. We help them implement, optimize, and stress test option strategies. From a retail trader, we try and work with retail traders to teach them a professional approach to trading. So all the way from starting with really understanding how options work, the theory behind them, all the way to really mastering the different strategies. All right, that's what we do. And you know, we've had clients that are individuals that we've had, you know, have as little as $1,500 to their name in terms of a trading account, and then I've had clients that managed over 10 billion bucks. So my big joke is we have clients that have 1,500 and clients that have 15 billion, and usually the guy with 1,500 knows more about options, and that's scary, but that's kind of the way the industry works. So what are you going to learn today? You're going to learn some fun stuff. So the key takeaway, all right, this is the overarching theme of today, is that volatility can act like a headwind or a tailwind to successful trading. All right, so I'm going to teach you some basic buy-sell decisions to profit from directional trading. We're going to discover how strike selection can make the difference between a good trade and a bad trade. I'm going to work on a combination of buy versus sell and strike decisions that pay off, and these are trades I do. And I'm going to teach you a little day trading, swing trading tip with VIX, how to use VIX in your day trading. If you're not using VIX and you're an active trader, you are missing out. So to start, the key to trading options for direction is correlation. Correlation really means how one instrument moves with another. What is VIX? We're going to learn all about that. All right. Here's what I would say is if you've got a question that's vitally important, ask, and if not, save it to the end. So correlation means how one instrument moves with another. So for instance, if I tell my wife that her dress is ugly, that is 100% correlated to me getting a shoe thrown at me. If you know, that is a correlation. The correlation of one means that two instruments move basically perfectly together. All right, think of two instruments that move very, very close to a correlation of one would be SPY and the S&P 500 future. Those absolutely have a close correlation. A correlation of an option, so an option on Apple, an option on IBM or Goldman or Tesla, it can never correlate to its underlying at a number greater than 1 or less than 1. Right? There are, you know, if you look at the dynamic like triple ETFs, you know, triple ETF should correlate at 3x to its underlying. All right? But an option will never correlate more than 1 or less than -1. Delta. Delta is the option trader term for correlation. Why do we use the term delta instead of correlation? I think it's because we think it sounds cooler. That's my theory. And in math or in calculus or different things like that, you might just call it slope. You know, my sister teaches high school physics and some high school algebra, And she's like, well, I don't get that whole delta thing. And what I told her is, all delta is the slope of a line. And she said, oh, so all you engineers should easily understand the concept of delta. Right? Delta can change, and this is kind of the weird thing with options, is that delta can change. All right? It can change with the passage of time. The question was, can't options move without the stock moving prior to an earnings announcement? And that's what we're going to talk about today. That's that volatility component. So, but that's a change in delta. So delta can change with the passage of time. I mean, think about it. If I own, Apple is trading, I don't know, let's, 1 second. Apple closed 94.20. All right. What do you think the odds are that it closes above 100? You know, what do you think the correlation of the 100 call is to Apple that expires tomorrow? Small. What do you think the correlation of the 100 call is that expires in 2 months? Probably a lot higher. All right, delta can change with price. So as the underlying price moves, a delta will move, how it correlates. You know, if I'm long a 100 call and Apple goes to 200, that 100 call is going to start moving like Apple. Or it can change because of that all-important factor that we're going to discuss today, which is volatility. So, you know, we commonly use correlation, but I've also heard it used. There's people that use terms like hedge ratio, a couple different ways of discussing. All right. So an option with a positive 0.6 delta will make 60 cents for every dollar the underlying rallies. It will lose 60 cents for every dollar the underlying falls, almost unilaterally. All right. So if I am long a 60 delta call, an Apple rallies $1, my call, let's say it was $2, will be worth $2.60. If Apple falls $1, my $2 call will go to $1.40. Very simple stuff. So what makes delta so hard is that relative to a stock, it can change on a trader. If I own 100 shares of stock, you know, I own 100 shares of stock. If the underlying moves up $1, my 100 shares will make $100. If the underlying moves up $2, my shares will make $200. Options don't necessarily work that way. All right. There are some very easy ones to understand, like I talked about, that passage of time. But the one that really has the greatest effect on your performance, the one key to directional trading is understanding volatility, which is one of the inputs in the model. Volatility, if you understand volatility and you trade options with an understanding of volatility for direction, you will greatly increase your likelihood of success. All right, so this is kind of how a call option moves with the underlying. Kind of a rough drawing. Right, the blue line represents the call option all the way until expiration. The green line represents 100 shares of stock. That's kind of how the slope of a correlation, the change in delta, happens. So has this ever happened to you? And I used to get this all the time. And you know, people would say, Mark, market makers are cheaters. I bought all these calls right before earnings, The stock is way higher, but I am not making money. Market makers are stealing my money. Well, what happened? Did that actually happen? Did market makers steal their money? No. The delta changed. The delta changed. So the Greeks, of which delta is one, that correlation, they're produced by a pricing model. All right? They are modeled risk based on inputs into the model. They're meant to help traders manage the risk of a given option position. So the thing to remember is that the Greeks, like delta, are not a hard number. They're an output of a model. All right? They do all sorts of modeling. Is modeling always right? Is modeling always right? Think about your weatherman. How often is your weatherman right? That's all climate modeling. All right, scientists use modeling to discuss all sorts of things. So there's an old term, garbage in, garbage out. And so if you put garbage in, you're going to get garbage out, so your delta can be wrong. All right? So since delta can change and is modeled risk, picking the right option for direction is key. Should an option be bought or sold? In the money, at the money, or out of the money? It all depends on implied volatility. So what makes trading volatility different than trading a stock? What is implied volatility? Over the long term, we know where implied volatility of a stock or index is going to go. We don't know where the stock price might go. Implied volatility can go anywhere, but it won't stay there. A stock price can just keep going and going and going. Look at Facebook. Just goes up. There's no mean reversion in stocks. So take a look here. This is a chart of Apple. Does it look like it has a mean to it? Not really. All right, if I pull up a Facebook chart or Goldman, does that look like, does Facebook look like it has a mean? You tell me. Does that look like there's a mean there? An average price? No. Now let's look at VXAPL. Now what is VXAPL? All right. VXAPL is the VIX of Apple. So it is a measure of implied volatility. And you tell me, take a look at that gray line. That gray line is the 200-day moving average. The red line is the 50-day moving average. Does that stock look like it has some mean reversion? Does that volatility look like it has some mean reversion to it? Yeah, I mean, it probably, if I drew a straight line from about 28, you know, something like that, there's your mean right there. So the key is a stock price can go anywhere and stay there, and volatility can go anywhere. In 1987, volatility theoretically went up to about 150%. I've seen biotechs where the volatility is 300%. It can go anywhere. It can't stay there. It will revert to its mean over time. So understanding this should help you with buy and sell decisions. So now let's talk about when to buy an option, when to sell an option. And anybody that tells you you shouldn't buy an option or you should never buy an option is clueless. In general, when implied volatility is low, in the near term and especially in the long term, and one wants to play direction, it can make sense to buy over sell. When IV is higher normal, it typically makes more sense to sell an option via call or put spreads, or credit spreads as they're often called. So when you want to get long, there are two ways to get long. If I want to get long exposure to the underlying, I can buy calls or I can sell puts. They both create long exposure. But each trade acts very differently. A short put is long delta and short vega. Now, what is vega? Vega is another Greek that we look at. All right. And it is kind of how your position is going to move as volatility changes. So if you're short vega, do you want volatility to increase or decrease, you think? Decrease. All right, if you're short, you want something to go down. So now what makes IV drop? All right, IV drops because movement drops or expectation of movement drops. So what a trader is really hoping is that the stock moves higher and movement decreases. So when you sell a put, you are not betting the underlying is going to go up. You are betting that the underlying isn't going to go down. Do you understand the subtle difference there? It's like hockey. You know, selling a put is kind of like playing old school overtime hockey, when a tie got a point and losing got 0 and winning got 2. So everybody played for a tie. What's the difference between a stock dropping and movement decreasing? So stock dropping means the underlying drops. So think of Apple going from 120 to 90. Movement decreasing means that Apple kind of stops moving. You know, if I pull up a chart of Apple, or yeah, here, Apple, and I'm going to pull up a chart of realized volatility. So this is actual movement. And this blue line represents 10-day volatility, 20-day volatility. So it's a backward look at how much Apple's been moving over the previous 20 days. And what you can see is movement's been increasing. Same thing in the last 10 days. So when you sell a put, you're betting that an underlying isn't going to go down, not that it's going to rally. You're betting it's not going to move lower by a lot. Not that it's going to go up. So here's JP Morgan. And you can see, look at kind of the volatility in and around here. This is implied volatility. So this is kind of like the how much the market is guessing JP Morgan's going to move. And you can see right here it's kind of high. And you can see JP Morgan right here. So what makes more sense here? Well, you can see JP Morgan creeps up to, about 58. But implied volatility goes from 24 down to 19%. In this case, I would have been interested in selling the 55 put. All right. Now, a long call is long delta and long vega. You're actually hoping the underlying goes up and movement increases. So what makes vol go up? IV come in. Does that mean IV comes in means implied volatility drops? That's a good question. Thank you. So what you're really doing when you buy calls is you're looking for an increase in movement or an increase in expecting movement. If you think a stock's going to go up, you should buy calls. All right? When you buy calls, you're betting the stock's going to go up. Here's Ulta. Ulta Cosmetics. This is one I've traded a bunch. You can see implied volatility hits a 3-month low here. Meanwhile, the stock is down. You know, as someone who thought Ulta was going a lot higher, this is an excellent chance to buy calls. Because what happens, on top of the fact that the implied volatility is low, take a look at the movement implied volatility. What happens? It goes up. Meanwhile, the stock goes up too. All right? So remembering implied volatility is an input in the model, my calls do really, really, really well. All right, now, like going long, when one is making buy-sell option decisions, one must take IV into account, implied volatility when getting short. So when implied volatility is high, you sell call spreads. I'm not a big proponent of ever selling naked calls. Call spreads, love selling. And when implied volatility is low and one thinks the stock's going to fall, you buy puts. So here's IBM. There's a couple of different times where it's made sense to sell calls. Let's take a look here. So you sell the 165.70 call spread. Take a look. Implied volatility drops. The stock just sits in a channel. It doesn't go up. That's your call sale. You get another pop here. Stock just kind of meanders lower. Nice little trade. When do you call relative to a call? Ask me that again later. And here's another IBM case. This is a little older. But take a look. After IBM had that big tank job back in July of 2015, they came in and just murdered the option prices. Think of this red line as the price of options. Well, guess what? I could buy a put at that 160 strike here or 155 and just ride it down. Worked out really well. All right. So, you know, good question. When am I generally looking? So when I see implied volatility hitting near 52-week lows after a big move, I love buying options one way or the other. Apple was a great example of this. I mean, let's take a look at what just happened in Apple. Right? A lot of people are like, no, Apple's the best ever. It can't drop. Well, let's take a look at Apple, its drop, and implied volatility. So what I want you to notice is here. Apple had a really bad earnings report and closed about 97.5 bucks. We were backing up the truck on put buys and straddles and things like that. Why? Well, we thought the underlying was going to keep going and implied volatility would rally. Well, guess what? I mean, let's look at the May 95 puts. You could buy the May 95 puts for $1.25 on April 27th after earnings. It's down 6%. I mean, I could buy the May 97 puts for under $2 after it just dropped $6. And these had 3 weeks to go. Think about that. Well, take a look at how well those performed. Look at my implied volatility. All right, May, I'm buying 22.1 here, and we'll just look at the implied volatility of the 95 puts. 23.22. Well, the next day, those $1.25 puts are worth $2.35, and the volatility is kind of unchanged. Volatility is up again. May is up again. And my 95 puts, the implied volatility is now 25, and they've tripled in value. I typically like to go about a month out when I'm trading duration on these. This is 30-day implied volatility. $30 days out, and I'm typically out with less than 2 weeks. So now let's talk strike selection. You can turn a good trade into a bad trade if you buy the wrong strike. So now that you know when to buy and when to sell, the next question is what strike to buy. All right? And this is done based on the certainty of the next vol move. All right? The next vol move. So when you think that implied volatility is going to go up, you want to buy softer deltas, and I'll discuss what those are. And when you think IV is going to be stable or go down, you want to buy a hard delta, and vice versa for selling. So a hard delta is relatively resistant to changes in implied volatility. Hard deltas are going to be in the money and at the money options. All right. A soft delta is relatively dependent on a change in volatility. Soft deltas are out of the money and far out of the money. So understanding the difference makes a huge, huge difference. What is volatility high means generally not specifically to stock. Ask me that again at the end. That's what I'll come back to. So when would you want to own a hard delta? When you're not sure of the future IV movement, when IV is very high, or when you aren't sure of the severity of the expected move and want to have limited risk. So here's a picture of Goldman. I think Goldman's going higher. But look at that implied volatility. So I should do one of two things. I should either sell puts or buy hard deltas. So I should either sell soft deltas here, so sell a put or put spread, or I should buy hard deltas. In this case, we're going to look at buying hard deltas because it's easier to compare. So my two options, I can buy the December 110 calls for $7.60, or I can buy like 8 of the 125 calls for 96 cents. Well, lo and behold, 8 days later, my December 110 calls are worth $10.65. And my 125 calls are worth $119. Notice the change in implied volatility, though. $29.60 to $27.60, $26.50 to $22.50, $22.75. So now let's walk through this. So if I buy one December 110 call for $7.60, I'm buying 70, a 70 correlation. I'm buying 70 deltas by 1. There's that delta. If I buy 8 of the 125 calls, I buy 130 deltas, right? Because 8 times 17 is about 130. And I spend $8 more. Well, you can see Goldman rallies $5. My 110 calls, I make $300 on my $1. Almost a 50% return. Not bad for a one lot. My 8 calls, I make $1.80. I only make $184 despite buying way more exposure. What happened? Volatility fell. My delta changed. I didn't get the delta I was expecting. I wasn't long 130 deltas all the way up. I wanted to buy the deeper in the money option. Now, soft deltas are more sensitive to changes in implied volatility. There are some very specific times where they can make a lot of sense. When IV is low, when you're expecting a major move, when you want an inexpensive bet and vol's low. So here's IBM. I think you can clearly see IBM vol is very low here. So again, I think IBM is going to rally. On the 21st, I buy a call for 680, or I buy 5 of the 195 calls for 122. Well, 2 days later, I made a good trade. My 185 calls are worth 930, and my 195 calls are worth 225. Look, though, and the implied volatility went up instead of down in this case. It went from 1320 to about 1360, and 1602 to 1649. Well, let's see which one made more money. So I spent $680 buying my 1 call and getting 75 deltas. I spent $610 buying my 5 195 calls. Well, 2 days later, you know, my 185 calls worth $9.30. You made $250. Listen, good work. You should always celebrate making $250. But my 5 calls that I spent $70 less on made almost 100%. They're up $515. Softer deltas outperformed by a landslide. Now here are some buy-sell combos that I use using implied volatility. So so the CBOE disseminates all these, you know, I use a neat program like LiveVol to make all my volatility decisions. But if you don't have LiveVol X, you can use something like, you know, CBOE has VXAPL, VX Goldman Sachs. They've got the GVZ, which is the Gold Volatility Index. OVX, which is VIX on oil. VIX on TLT. VIX on the 10-year. Well, that makes me happy, William. All right. So follow these VIX methodologies. If a stock hits a 52-week high, and then that index hits a 52-week low at the same time, wait 1 day and then buy a call that is out of the money. The first call at about 30 to 60 days to expiration. I've done this in Goldman about 100 times. This was one of the better ones that I've done. We haven't seen a lot of 52-week lows, but when vol's low, I mean, it's like clockwork. Look at these points. So super low vol, Goldman rally, right here. Super low vol here, Goldman rally. Super low vol here, Goldman rally. All right, so when a vol hits, when VXGS hits a 52-week low, and a stock is at or near a 52-week high, wait a day, then buy the first call out of the money at about 30 to 60 days to expiration. Here's Tesla. All right. Now, take a look. They got earnings. Stock pops and drops, and vol's getting really low. What do you think here? I'll tell you. When IV or a VIX methodology hits a 52-week low and a stock hits a 52-week low at the same time, buy the second put out of the money. Sinking IVs and sinking stocks almost always means the stock's going to go a lot lower. I mean, yeah, this was absolutely either buy out of the money call or out of the money put. For sure. Not a 52-week low, but it was absolutely going to be moving higher. So take a look here. Here is GVZ. And what I want you to notice is that, and so GLD is here, and here's GVZ, gold vol. What do you know? It hits a 52-week low right here, and gold is right at a 52-week low. All right, and so if I bought like the 107, 108, 107 put, how do you think I did buying that super cheap vol? We can go back and look. That's not from that long ago. All right, here's my date. And GVZ is, it's October 30. I'm going to buy the, we'll just buy regular December. And I'll buy the regular December 107 put for $1.40. How's that performing? Well, look at the vol. $2 higher, stock $6 lower. How are my 107 puts? Not bad, huh? Yes, the webinar will be recorded. So now let's talk about a little bit of using VIX and VXX and VIX futures. So how many of you trade, people that trade ES and SPY and stocks, they almost never lead VIX, VXX, and the VIX futures. VIX futures almost always lead what's going on. So I want you to notice, this is obviously not from today, but I want you to notice is take a look at here. You've got SPY super choppy. And then down here, I've got VXX at the same time slowly rallying from about, and there's no news. So VXX is rallying from, I'll call it 32.5 all the way up to about 33.5. Meanwhile, S&P chop. Well, what happens? S&P breaks down, VXX keeps going higher. So when you see vol increasing and the underlying isn't going down, something is about to happen, and vice versa. All right, if I put VIX futures or VXX under SPY today, you'll see it. Let me just do that. me, oh no, I want this one unbound. Oops, sorry folks. Unbound, apply, and then I want this one bound. I'm going to show you VXX, and we'll look at one day. So take a look here, guys. You can see the S&P is tanking. And VXX starts to get real soft real fast. And if you look closely, what you'll notice is that within these ticks, VXX is about one little candle ahead of SPY. VXX is going to lead. So when even though SPY is flat, so when SPY is flat and VXX is rallying, that is a huge tell that the market's about to drop. And vice versa. When the market is dropping and VXX is starting to sell off, that is a huge tell the market's about to rally big. So, in summary, vol reverts. Implied volatility helps form positions. There are different types of delta. Yeah, VXX is the leading indicator. Not all the time, but most of the time. If you add that into your general day trading, you will see a benefit, is kind of my point. VXX and VIX tend to lead. VIX future is even better. So now let's talk about my deal. So on June 11th, we're doing our next Saturday class. It's on condors and butterflies. That is included with a subscription to Option Pit Live. All of our Saturday classes are. And so for just $17, now it's normally $125, you are going to get access to our strategy letter. Now, what's our strategy letter? We enter, manage, and exit trades and keep track of the P&L, profit and loss. You're going to get access to our chat room where you can work with me and my employees. I work with professionals that are all better traders than me. All right, I don't have my own students leading things. It's all professionals. The guy who works with me is the guy who taught me how to trade. All right, so you're going to get access to our chat room. You're going to get access to the pit report where we walk through each of our trades and talk about the new trade we're putting out for the day. That is recorded every day. So even if you're working, you can go back and see why we wanted to do a trade and what we were thinking. The strategy letter sends you emails, all sorts of different things. Yes, I will kindly do so. So you get all sorts of emails from us with kind of, here's how we're updating the trade, here's what we're doing. You get email support from us, and you get all sorts of other stuff. And the Saturday classes are included. Now, the Saturday classes, we charge $169 for those. The monthly subscription is $125. We do 11 classes a year, yet people still buy the classes outright instead of the subscription. I don't get it, but they do. All right. Now, this offer is going to be good until Saturday. Excuse me. It's going to be good until, what's today, Thursday? Sorry, it's good till next Wednesday. Lost track of my day. All right, you got questions, you can email me, marketoptionpit.com, or you can call us. I'd be happy to cover. Do you have any questions now? I'll take questions for a couple minutes here. For how long is it? It's 1 month. And then after the first month, it's $97. $17 for 1 month. So if you bought it today, I will be asking you for more money on June 19th. Can you please explain why half of a call or put spread is not considered naked as you don't own the stock? What? Well, because it's hedged. You've got a long versus a short. That's why it's not naked. You've got limited risk. Naked means you've got unlimited risk. So if the underlying, if I'm short an Apple call at 100 and it goes to 200, I lose a lot of money. If I'm short a 100-105 call spread, I can only lose $5. That's why it's not naked. It's got a defined risk. Naked is really defined as undefined risk in a name other than zero. So can we have a link to the recording? It will be on, there's one a month. There's one a month. What is the value of volatility is high? Every stock is different. S&P has its own, it has VIX. How are deep in the money calls affected by vol? They're less affected, but they are affected. And this is a recording. We will send this out. But it will be on my blog, optionpit.com/blog, for you to watch in, a couple hours. Can you tell approximately how many recs you give? We do about 3 trades a week. What's the charting platform? I'm using LiveVol X. Market in general, high vol is going to be in VIX. High is above 20. Low is below 13. Everything else is kind of in between. Yeah, we follow all of our trades from start to finish, Pamela. LiveVol is a charting and execution platform. This is LiveVol for Lightspeed, so I actually execute my trades. With the subscription, is there access to past classes? Some of them. Do you cover option flow, option futures? Don't really do. We do to some degree, but not a ton. We've done well this year, and we trade with about $15,000. Would you know which Saturday in the up? Yes, it's condors and butterflies. Yes, we show a full record of all of our trades for transparency. What date? June 11th. I love that dress. Yeah, most of our stuff is relatively low cost. Our average trade is uses about $750 to $1,500. So we really only do. I mean, the account has about, I think at this point, 40 grand in it, but we only trade 15,000. Yeah, our typical trade duration is going to be 5 days, 1 to 3 weeks is what I would say. All right. Any other questions? What's our average profit per trade? I don't know that off the top of my head. I can absolutely get you a recommendation for software for charting volatility and stuff like that. I've got all of my... I manage a hedge fund, but the strategy letter is simulated trades in my spare time, just as an FYI. So I am a professional trader that teaches. Yes, there is a NASDAQ VIX. It's called VXN. When do I buy out of the money or at the money calls relative to volatility? When it's low, really low. And we do some of our own trades. What's my outlook on SPY and XIV? I think things are super choppy here for a while. I don't know that I would want to be long a ton of XIV. I'd rather own puts in UVXY. Am I day trading or swing trading? I trade VIX, and it is position trading. And most of our trades are position trades. They are simulated. I take some of them, not all of them. VIX and S&P is what I trade professionally. But our strategy letter trades all sorts of things. Yes, you get trading room access for the 17 bucks. I trade VX, VX options, VXX, UVXY, and SPX primarily. And we do a lot of the volatility ETNs and VIX trading as well in our room. But we do some other things. You know, I caught that Monsanto move in the room the other day, and a lot of people made a lot of money on that. I bought a call spread for 15 cents that I sold at $4 and $4.50. What type of I use VX, VXX, UV. There's all sorts of ones. You'll learn that when you're in the room. Yeah, we do a good mix. As I said, the typical duration is 5 to 15 days, trading days. What are the IV values, high, low numbers you provide? I mean, we'll discuss that on a per trade basis. You know, it really depends on the stock. It really does. Can you have a copy of this webinar? Yeah, it'll be on the, I'm going to post it on the blog. Yeah, that was a nice trade. We open a trading room about 8:50 Central, and I try to pop in the trading room every day for at least 45 minutes. And really, Andrew's there, and we've got Andrew, who's my number 2, in there for a good couple hours a day. I don't have an outlook on Nugget. I'm sorry. Yeah, 8:50 a.m. CST till 3 o'clock CST. Haha. What's your? I have no idea off the top of my head. All right. And I have to go to Members Night at the Field Museum to take my